History repeats itself. This is especially true in economics. By studying past economic cycles, we gain valuable insights into the present and the future. These cycles are not random events. They follow identifiable patterns. Understanding these patterns can help us make informed financial decisions. Economic cycles are like the seasons. There are periods of growth and prosperity, followed by periods of contraction and decline. Each phase has its unique characteristics. Recognizing these characteristics allows us to anticipate changes and adapt accordingly. Just as a captain must understand the tides and currents, we must understand economic cycles. This knowledge empowers us to navigate the financial waters with greater confidence. Ignoring the lessons of history can lead to financial hardship. By embracing the wisdom of the past, we can make smarter choices for a more secure future. The Great Depression and the 2008 financial crisis serve as stark reminders of the importance of understanding economic cycles. These events, though decades apart, share striking similarities. Both were preceded by periods of excessive borrowing and speculation. In the 1920s, rampant speculation in the stock market led to an unsustainable bubble. When the bubble burst, it triggered a chain reaction of bank failures and economic collapse. Similarly, the 2008 crisis stemmed from a housing bubble fueled by subprime mortgages. These mortgages were bundled into complex financial products and sold to investors worldwide. When the housing market crashed, the financial system teetered on the brink. Examining these historical parallels reveals a recurring theme. Financial crises often arise from a disconnect between asset prices and their underlying value. By studying these events, we can learn to identify similar patterns in the making and take steps to mitigate their impact. Overleveraging and asset bubbles are two key indicators of an impending economic downturn. Overleveraging occurs when individuals, businesses, or governments take on too much debt. This excessive debt can create a fragile financial system. When asset prices rise rapidly and become detached from their underlying value, asset bubbles form. These bubbles are often fueled by speculation and herd mentality. Investors, caught up in the euphoria, ignore the fundamentals and drive prices to unsustainable levels. The dot-com bubble of the late 1990s is a prime example. Investors poured money into internet companies with inflated valuations and little to no earnings. When the bubble burst, many of these companies went bankrupt, and investors lost billions. Recognizing these warning signs is crucial for making sound financial decisions. By exercising caution and avoiding excessive risk, we can protect ourselves from the worst effects of economic downturns. Economic cycles are a natural part of the financial system. Just as the seasons change, so too does the economy. Attempting to fight or deny these cycles is futile. Instead, we must accept their inevitability and adapt our strategies accordingly. Understanding that periods of growth will inevitably be followed by periods of contraction allows us to make more informed decisions. During periods of expansion, it's essential to build a strong financial foundation. This includes saving for the future, diversifying investments, and avoiding excessive debt. When contraction occurs, we can draw on our reserves, adjust our spending, and weather the storm. By accepting the cyclical nature of the economy, we can avoid making emotional decisions and instead focus on long-term financial well-being. Section 5. Weathering the storm. The power of strategic diversification. Strategic diversification is essential for mitigating risk and ensuring stability in a volatile market. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. This strategy helps to cushion the blow when one asset class performs poorly, as others may perform well. Imagine your investments as a fleet of ships sailing in different directions. If one ship encounters rough seas, the others may sail smoothly, ensuring the overall fleet remains stable. Similarly, a well-diversified portfolio can withstand market fluctuations and deliver consistent returns over time. By diversifying your investments, you create a buffer against the unexpected and protect your financial future. Section 6. The debt cycle. A powerful force shaping our economic fate. The debt cycle plays a crucial role in shaping economic cycles. When interest rates are low, borrowing becomes cheaper, leading to increased spending and economic growth. This growth, however, often comes at the cost of accumulating debt. As debt levels rise, so too does the risk of a credit crunch. A credit crunch occurs when lenders become hesitant to lend money, fearing borrowers may default on their obligations. This tightening of credit can lead to a slowdown in economic activity, potentially triggering a recession. Understanding the debt cycle is vital for policymakers and investors alike. Policymakers must carefully manage interest rates and government spending to avoid creating unsustainable debt levels. Investors, on the other hand, can use their understanding of the debt cycle to anticipate potential risks and adjust their investment strategies accordingly. Section 7. Case Study: The Dutch Tulip Mania and the Dot-Com Bubble. The Dutch Tulip Mania and the Dot-Com Bubble are classic examples of asset bubbles and the dangers of speculative investing. In the 1630s, tulip bulbs became a highly sought-after commodity in the Netherlands. Prices soared to exorbitant levels as people speculated on their future value. At the peak of the mania, a single tulip bulb could be traded for more than the cost of a house. Similarly, the dot-com bubble of the late 1990s saw investors pouring money into internet companies with little regard for their underlying fundamentals. In both cases, the bubbles eventually burst, leaving investors who bought at the peak with significant losses. These historical events serve as cautionary tales about the importance of rational investing and the dangers of getting caught up in market hype. Section 8. Dalio's Principles Navigating the Economic Landscape. Ray Dalio, a renowned investor and hedge fund manager, has developed a set of principles for navigating the complexities of economic cycles. Dalio emphasizes the importance of understanding history, recognizing patterns, and adapting to changing circumstances. He advocates for a data-driven approach to investing, emphasizing the need to analyze economic indicators and make informed decisions based on evidence. One of Dalio's key principles is the concept of radical transparency, which encourages open communication and the sharing of diverse perspectives. He believes that by embracing diverse viewpoints and challenging assumptions, we can make better decisions and avoid costly mistakes. Dalio's principles provide a valuable framework for understanding economic cycles and navigating the financial markets with greater confidence. Section 9. The Importance of Education: Empowering Yourself with Knowledge. In the face of complex economic cycles, knowledge is power. By investing in our financial education, we empower ourselves to make informed decisions and achieve our financial goals. Understanding basic economic concepts such as inflation, interest rates, and market cycles is crucial for making sound financial decisions. Numerous resources are available to enhance our economic literacy. Books, articles, podcasts, and online courses provide valuable insights into the workings of the economy and the principles of investing. By dedicating time and effort to expanding our financial knowledge, we gain the confidence to navigate the complexities of the market and make informed decisions that align with our long-term goals. Section 10. Taking Action: Applying Historical Insights to Your Financial Life. Understanding economic cycles is not enough. We must take action and apply this knowledge to our financial lives. Begin by assessing your current financial situation. Evaluate your income, expenses, assets, and debts. Develop a budget and a savings plan that aligns with your financial goals. Next, consider your investment strategy. Diversify your portfolio across different asset classes to mitigate risk. Consider your risk tolerance and invest accordingly. Finally, stay informed about economic trends and adjust your strategy as needed. By taking a proactive approach to managing our finances, we can navigate economic cycles with greater confidence and achieve our long-term financial objectives. Section 11. Conclusion: Embracing History for a More Resilient Future. History has much to teach us about the cyclical nature of the economy. By studying past economic cycles, we gain valuable insights into the present and the future. Recognizing patterns of over-leveraging, asset bubbles, and debt cycles allows us to anticipate potential risks and adapt our strategies accordingly. Strategic diversification, a data-driven approach, and a commitment to lifelong financial education are essential for navigating the complexities of the market. By embracing the lessons of history, we can build a more resilient financial future for ourselves and generations to come. Remember to subscribe to this channel for more insightful content on economics, finance, and history. Share this video with your friends and family and leave a comment below sharing your thoughts on the importance of learning from historical economic patterns. If you'd like to support our work, consider becoming a Patreon or checking out our merchandise. Together, let's embrace the wisdom of the past to create a more prosperous future.